ladies and gentlemen. After a short pause, good morning, Doc. How are you?
Yes, I'm great, Graeme, and we are here today at the end of May. So, of course, we now will be within a very short period of time in winter. And, of course, it feels a little wintry down the east coast at the moment, particularly in Sydney and Melbourne. Lots of sunshine in Sydney, but it is frosty. And the winter market, of course, really doesn't start, or the winter housing market doesn't start until the end of June. So we've still got a month or so to run with the autumn selling season. And, of course, that's the notional autumn selling season, not the sort of official one in terms of the months, because we are moving out of autumn now in terms of ending May. But plenty of action in our housing markets, Graeme. Housing markets really have got a head of steam up, particularly Melbourne and Sydney. We'll look at the latest data, but all the underlying data is also improving for the outlook for housing markets as well. And we'll look at the latest data in terms of that. So I'm talking about supply versus demand. And I'm also talking about interest rates, Graeme. And I think we're getting the first maybe glimmer that interest rates may peak earlier and lower than many have predicted. Of course, a lot have predicted a lot of different things, but I think the expectation has been that they would continue to rise, and I think they will. But we've just, we rely on the data. The Reserve Bank kept telling us, well, we're going to wait for the data, but they didn't wait for the data and paused rates in April, which I think was just a little bit premature. But I think now we're starting to see, and let me emphasise, very early signs that higher interest rates may be having the effect that the Reserve Bank wanted in terms of consumer activity. Now, 1 month doesn't make a lower interest rate, but if we build on the better results we've had from the Reserve Bank's perspective over the last month, then we may start to see a pause in rates sooner rather than later. And that's good news, Graeme.
Well, this time last year, Doc, it was Mayday. Everyone, the sky is falling, the market's crawling. We've been hearing this dribble and rhetoric for years now, but I think those people timing the market, I'm safe to say, seeing your data when you send it through, they've missed the bottom.
Yeah, well, the bottom came in Sydney in February, Graeme. In Melbourne, it came in March. We've had consistent price increases in both those capitals since then. Of course, they led the market downwards last year at the end of very strong boom time conditions. We see that anyway. Markets, when they peak in a boom, push buyers out of the market, and that creates that softening of activity. It's completely logical. And a lot of the pent-up demand through COVID was also satisfied. So that's why we saw an easing at the beginning of last year. Of course, it was exacerbated by higher interest rates, which scared the hell out of a lot of buyers and sellers for at least a couple of months. But that's all past now on the back of a booming economy. Housing markets have been improving since August last year, Graeme, and now we're back in the black. It shouldn't be a surprise because the trend has been pointing to that way anyway. Despite 11 interest rate increases, we're now talking about back to the boom in Sydney, and we're just a year of higher interest rates and still raising rates, and we're now talking back to the boom.
So we're out of a pandemic. We're out of what was meant to be a housing cliff, crash, disaster, despair, dismay, and within a year we've had 11 rate rises. The market dropped 4% and a bit, houses units, and now we're actually on the up and up, month on month.
Yeah, well, really on the up and up too, Graeme. As we'll see with
not just a little, like we're really on the up and up.
Yeah, and the big picture here is that we shouldn't be surprised that once confidence was recovered, and really it was just really being scared about, the dark. And once we realised the roof wasn't falling in, a very strong economy with very strong wages growth is activating consumer positivity. It's not just out buying a new car or a new fridge. People are thinking, hey, I'm going to buy a new house as well, because prices are still lower than where they were a year ago. And this is the big value perception that the market has. And it's not just a perception, it's a reality that it's a good time to buy because you're still buying below peak prices. Still in Sydney, it's still, and Melbourne, around 5% lower than it was a year ago. But, it's already picked up 5% this year, Graeme. And I think now that Sydney and Melbourne are primed to record 10% plus growth this year.
Well, that's a big call, though.
Well, we're halfway there, Graeme, and that's to May. And we've got the prospect of maybe not having as many interest rate increases towards the back end of this year.
I see the headlines, Doc, they always say 10% price crashes. I wonder if we'll see a 10% price growth prediction in the media at all. Is there any clickbait in that, do you reckon?
Well, I put that out today, saying that that's now becoming increasingly likely. We'll see if it gets picked up. But as I said, we're halfway there, Graeme. We're at 5% in Sydney. We're still 5% below where we were a year ago. So all I'm saying is that by the end of the year in Sydney and Melbourne, we'll just get back to where our peak prices were at the beginning of last year. So, the real question will be, once we get back to peak prices and there is no more of that sort of value opportunities, whether we'll see prices growth as strong. Now, I don't think we will, because we just can't keep pushing up prices without either lower interest rate or higher incomes. Now, we'll have the higher incomes, but I don't think we're going to get lower interest rates, certainly not this year. I think we're lucky if we get flat interest rates this year, which I think is becoming more of a likelihood. Still an outside chance, I believe. But when we look at the latest data today, we'll see that there's now more signs pointing to relief for the Reserve Bank, who may be starting to think, oh, thank God, at last we've seen some action with higher interest rates, so we won't have to keep putting them up, I think that we've got 10% in the gun this year in Melbourne and Sydney, Graeme. Now, we predicted 8% this year. So, I think it's going to be a little stronger than we predicted. But, hey, there's a bit of water to go under the bridge. We've still got 7 months of housing market activity. So, let's see what happens before we start getting too carried away. But every post has been a winner, particularly in Melbourne and Sydney this year, Graeme. And I don't think even those government measures, which have really got everybody scratching their head at the moment, are going to slow the market down. In fact, they probably will only add to particularly higher rents, in my opinion.
Yeah, we'll touch on that quickly, Doc. I mean, a lot of clients have expressed concern with that, and I said, look, what are you? Yes, the government wants to pull back $30 billion of spending, but realistically, I think it's about a fixed fee over 100 or something. It's $975 or something like that, and over 300 grand, it's 0.1%. Like, it's not going to break the bank, and what it is going to do is that cost is going to be passed on to renters. And these policymakers going, oh, we're going to do this, this, and this, but we don't want to see it passed on to the poor tenant, right? Because there's a political spin. But let's be honest, someone's providing a service, they're putting a roof over someone's head who can't afford to buy. They've got to cover their costs.
And the ultimate issue here is, Graeme, if it's not higher rents, it'll just be fewer houses. There'll be absolutely fewer rental properties, because if landlords feel that they can't operate profitably, they're just businesses after all that take risks. There's no guarantee that they're going to find a tenant or they're going to get the rent to cover their costs. If they don't, they'll look for alternative investments. And now if that happens, God forbid, we'll have fewer rental properties. And the last thing we need is fewer rental properties with massive migration, particularly into Sydney and Melbourne. And the latest building approval data, Graeme, is, let me use this word advisedly, shocking. You hear me? Shocking. Terrible numbers coming through. We're just about getting to the point, particularly for apartments, where we've just stopped building. So, the big picture is that going on into the outlook, we're going to have fewer properties coming into the market, new properties, to be able to satisfy demand. And of course, as we've discussed consistently, it's not just the building approvals that are collapsing. A lot of these building approvals are not going to become actual jobs. They're not going to get out of the ground, because even though building costs have eased just slightly, they're still rising at well above 10% a year on current trends, and they're still high. And they're not coming down, to where they were anywhere near pre-COVID. So builders have got to absorb these high costs and still try to make a profit. So, it's just bleak out there if you're not, in my opinion, a homeowner. And I don't know where governments can go. They've got, in the first instance, governments have to, I guess, work towards balancing their budgets. And that means, if you've created the taxes that mean you've spent more, that means you've got to earn more. And if you're earning more, that means, hey, someone's got to pay the bill. And no surprise that, there's the target is the top end of town, or those that are perceived to be more likely to be able to afford to pay the bill. But as I said, in terms of hitting the property market, and particularly investors, it's a cleft stick, because either they pass it on to the tenant, and if you try to stop that occurring, then you create a disincentive for investors, and they just look elsewhere, and you have fewer investment properties. And, the ridiculously minimal, not ridiculous, but they're minimal attempts by governments to provide public housing aren't even scratching the surface of what we need. We need millions of homes, not, 10, 15,000. And, they will look after the marginalised. But believe me, Graeme, we're going to see more and more marginalised, in terms of those looking to put a roof over their heads over the years to come. And I believe there's absolutely nothing governments can do about this unless they really stuff things up big time, So you've just got to sort of wait and hope, and perhaps realise that, housing really has become the goose that laid the golden egg for those that have housing. And those that don't have housing, well, you've really got to work your butt off to get into that housing market to offset what are going to be, really negative conditions going forward in terms of finding a roof over your head.
I think you nailed it. You've nailed it. You've got to work your butt off. People go, but how do you rent and save a deposit? And most people live with their parents. Some people got married and they had multiple jobs and they took their cut lunch. And you really do have to work your butt off. You can't just expect that it's going to be gifted to you.
That's right, Graeme. And look, there are plenty of incentives out there, and big tick to governments who are providing those incentives for first home buyers. And isn't it interesting that the latest home loan data is showing the first home buyers are clearly the most active in the rebound market for home lending? Of course, why wouldn't they be? They know that prices are still lower than where they were a year ago. They've got plenty of government incentives to get into the market. And of course, the real incentive to get into the market as an owner is, please, I don't want to rent, because it's a nightmare, The numbers we're getting through, and we'll talk about the latest rent report next week, Graeme, for May, and just the preliminary numbers are just really sobering, particularly in Sydney. I have to keep checking the data to make sure it's right, because, it's just skyrocketing rents to sort of unbelievable levels, particularly for units, Graeme. The unit market, I think it's people have just given up on having to rent a house and now are shifting towards units because they were the most affordable option, but also perhaps they're the most convenient option in terms of, access to workplaces and infrastructure, etc. So, particularly in Sydney, which is just a horror story for tenants, going forward.
All right, well, let's have a look at the data, Doc, because I think it's one thing for us to say it, but it's another thing for people to see it.
Yeah, well, as you know, Graeme, we always support what we say. Our commentary is always clearly supported with data. We don't really proffer opinions here unless they're supported, and that means that if perhaps what we say isn't what eventuates, we can always blame the data, and that's the point. It's a jigsaw puzzle, but you have to put the jigsaw pieces together to craft the narrative that we come up with. And I guess that's why we're reasonably successful in terms of our commentary and our outlooks, because we have multifaceted data to support our opinions. And I think that's the way that you should go, well, absolutely is the way you should go. So the economy's still booming, Graeme, very strong economy, but hang on, we put the word but in there. But what? Well, we had another strong labour market result over April, clearly reflects a booming economy. But Graeme, just a very early sign of an easing activity, but from a record high. And that's maybe better news for the outlook for interest rates. Now, we had a similar result in January where the labour market just looked like it had come off the top. but then it bounced back very strongly in February and March. And of course, that just re-emphasised how strong and resilient our economy is. But again, we've gone to the latest April data, which gives us a sense that the economy just might be feeling the effects of higher interest rates. And come on, Graeme, 11 interest rate increases in a year. Come on, something's got to happen. Well, the unemployment rate increased to 3.7%, Graeme, still a spectacularly low result, 3.7%. Give me a break. But it is the first sign of just a tickle upwards. Now, let's emphasise this. Nobody's calling anything at the moment. But what we're saying is this is the first sign, perhaps, that higher interest rates are impacting the economy. Well, we don't need to look at this, or we don't look at this data set on its own, and we'll support that with some more data in a sec. But certainly the labour market had a weaker result over April compared to March. Now, all capital cities are still recording, very low unemployment rates, or the states are still very low with their unemployment rates. So, nothing to get too excited there. Everybody is in the threes except South Australia. And these are remarkably low numbers, 3% unemployment rates. April, we had slightly higher unemployment rate, 3.7%. Jobs were down 4,000 over the month, Graeme, and that followed a very strong March quarter of jobs growth. So maybe a little settling there, but certainly down following a couple of months of very strong growth for jobs. The unemployment number also increased, up by 18,000 over the month, and that follows again a couple of months where we've seen the number of unemployed falling, so it bounced back up again over the month. The participation rate, it just fell a little bit, so that meant there were actually fewer people in the population in the workforce, down a little bit, but as we saw there, all states recorded low unemployment levels, and maybe those rate increases are just starting to have the effect that the Reserve Bank wanted, which was to just ease this booming economy. It is the first month. We need to watch for a couple of months in a row. I think the Reserve Bank, which meets next week, Graeme, would be a little premature to be, I guess, thinking that this is a sign that they can rethink their interest rate strategy. But you never know, Graeme. They paused it in April. Maybe we'll see a pause for June, but I think it's still likely we'll get an increase. But I think it's a little bit more of an even money bet, Graeme, with this latest data. So the labour market just a little easier. So also we had the latest retail sales data, Graeme, out for April as well. And this was interesting, and in a sense it supports the labour market data. We actually had a flat result over April for retail sales. So retail sales were actually the same over April as they were for March. And that's the first real flat result we've had since the COVID period. So again, this is another sign that spending's starting to ease. Now, let's be clear that levels are still very, very high and well above where they were pre-COVID. So we're still spending, quite heavily, but it's the first sign that the trend is now starting to ease. Now, a couple more months with an easing trend, again reinforces that interest rates are having an impact, Graeme, and again sets the scene for the Reserve Bank to say, okay, well, we're getting these early signs. Maybe we'll wait and see, what's going to happen now because we've seen those early signs. We don't want to see an acceleration of an economic downturn or the creation of an economic downturn. So maybe they'll take that on board and pause rates again next week. But certainly we've got two clear data sets, Graeme, that are telling us that perhaps early days interest rates are now doing their job. And really, Graeme, this is good news because we're still got a very low unemployment rate. Retail sales are still, extraordinarily strong. And yet we may see this activate the Reserve Bank to pause interest rates. Now, as I mentioned before, Graeme, we had some shockers in terms of the latest home building data for April. Overall building approvals were down 8.1%. That's a really sharp decline over a month. Houses down 3.8%. Units were down again 16.5% over the month. And that followed an 8% fall the previous month. Total approvals are 19.7% lower over the year to April compared to the same period last year. And Brisbane's still the top performer over the past year, up by 3.5%. but the other capital cities are really struggling in terms of new building, and Sydney the worst performer, down again by nearly 40%. You can see the trend in building approvals there falling quite sharply. Units have really, are heading towards the bottom. We're seeing near record low levels for unit approvals, Graeme, on a month-by-month basis now. And you can see just how it's really collapsed this year, unit approvals there in the grey. Bad news on a number of fronts, not just for the big picture, but also that units are becoming, I guess, a more preferable housing choice. It's becoming more popular unit living, but we're just not matching up that demand, with supply, and that's really, terrible news for the balance of housing markets going forward. And again, it just reiterates how important it is to, be a homeowner or investor. With obviously we're running out of new supply coming through. We can see the numbers there, quite terrible. Those numbers, that's the monthly numbers. Everybody down. Houses, units, and total units down 16.5 year to date. Units are down 28% over this year compared to the same period last year. And the full year data is still being affected on the house side by the end of the home builder policy, which has really, exacerbated all these problems that we have. There's the big picture trend. We're so far behind our trend new building compared to our peak back in 2016. That's the essence of why we're seeing higher rents and eventually higher prices, because we've run out of housing. We're just not building what we used to build. And even though we had that surge in the black there through home builder in house building approvals, you can see that the background there in the lighter colour is units, and they're well below where their previous peak was. In fact, they're around about half what our peak was, what we're building now. And this is on trend. And we know that, the latest monthly data is just really quite sobering in terms of trying to get back to providing the housing that we need. Building approvals, Brizzy the best over the year so far to April, but everywhere else down. And Sydney's still around 40% fewer homes being built compared to over this year so far compared to the same period last year. And Melbourne's still the top performer for houses approved so far, or for homes approved so far this year. And Sydney just starting to catch up a bit on Brisbane to date, but still well below the Melbourne results. So, Graeme, our underlying economic commentary is behind us. So let's have a look at the real deal here, which is May home prices. So here it is. First to see, this is the May home price report. Again, we can see the national housing market has continued to recover. House prices actually accelerated over May, and these are national house prices and have now increased for the fourth consecutive month. There's the chart, Graeme. You can see that real rebound happening. This is the national house price model, still below where it was a year ago, but clearly really rocking upwards significantly since bottoming out in February. As we know, it's the national house price, because it's a weighted average of listings, is really about Sydney, Melbourne and Brisbane. So no surprise we're seeing there of the major capitals, Sydney leading the charge over May with an increase. And these are quarterly prices changing from month to month. So it's the May quarter versus the versus the April quarter. Sydney house prices up by 1.4%, Melbourne up 0.6%. That's Melbourne's third monthly growth result, and Brisbane up also similar to Melbourne. If we look at the year so far, Sydney up 4.9%, Melbourne up 2%, Brisbane up 1%. But as you can see, it's still good value in the market, because house prices, even though they're rising, and particularly in Sydney rising strongly, they're still below, to this point anyway, where they were a year ago. And I think that increasingly drives buyers into the market, because it's that fear of missing out energy, Graeme. They want to get back into the market before they're paying back to peak prices, which looks like it's going to happen sooner rather than later. And I think, on that data, clearly, I think we've got a 10% growth rate, particularly in the Sydney market. And I think also the Melbourne market this year. But I think, it would be almost getting towards an even money bet that we'll get 10% prices growth in Sydney over 2023. National unit prices similarly still rising, Graeme. Unit market, in fact, is probably still performing better than the house market at the moment. Sydney up 1.1%. There's a lot more even spread here, better performance. Melbourne up 1.6%. Brisbane just eased 1.3% over the quarter, and but we can still see that prices are higher by 2.3% in Sydney over the year so far, or over the year, and up by 2%. So house prices still on the rise, Graeme. No surprise. We've been foretelling this because of the strong results we're getting in our weekend auction markets. And we had another big weekend to finish May. I guess we shouldn't be surprised at these results as they're coming through. We know that house prices and auction clearance rates track each other, and we're seeing the validation of that in the latest price data in both Melbourne and Sydney. So last weekend's results, Graeme.
Oh, so close.
So close.
So close.
So close. 79.8% increase there in 79.8% auction clearance rate. And we really can't get much closer than that. Will it be this weekend, Graeme? Will all the positive news about house prices reinforce buyer sentiment? And will we push over to that 80% mark? Look at Melbourne, 78.6. It's also closing in on that 80% benchmark. Brisbane, which I think, Graeme, that Brisbane market is just starting to get its second wind. Obviously, it was one of the last markets last year to move into that easing cycle after very strong growth in 21 and into 22. And we know that was driven by migration to a large degree. It did ease towards the end of last year and into this year as that migration effect waned. And, of course, high prices started to sideline buyers as well. But I think that Brisbane market is certainly showing some signs now of bouncing back into growth. And, again, as we always mention about Brisbane, it tends to have a strange outcome in terms of its clearance rates. But, once you start getting these sort of results in the Brisbane housing market, something's afoot. And I think that we're starting to see early signs that Brisbane market is back in the black and starting to, move upwards again. And we shouldn't be surprised at that. Adelaide, as usual, big result for Adelaide. It always tracks around 80%. And the Canberra market, I also think, is very interesting, Graeme, because the Canberra market has been an underperformer. Again, it was last to come to the party in terms of an easing in the cycle last year. It does tend to follow Sydney. I think perhaps a few of the taxation positions that were introduced into that Canberra market may have impacted the market outcomes to some degree. But however, there are now signs that Canberra market is picking up. And again, as we've consistently said, Canberra tends to follow the Sydney market upwards, and it from those mid to low or mid to high 50% clearance rates it was recording through most of the early part of this year, it's now bouncing back into the 60s. So watch the Canberra market going forward, Graeme. So we have the full monthly results now. Look at Sydney. Over the whole month, 79.4% Sydney average. Now, that's the highest monthly clearance rate that Sydney's recorded, Graeme, since October 2021, which, of course, was the peak of the boom coming out of COVID lockdowns. So it's the strongest result on a monthly basis for an auction clearance rate, weekend auction clearance rates for Sydney since October 2021. And, have a 79% clearance rate really does show you that it is a seller's market at the moment. There are more buyers than sellers generally. That's why prices are rising. And that's why we're starting to roll out the B word, because clearly that's what it is. We'll get to 80% probably next week or maybe the week after. We'll see. It's going to be interesting to see how that pans out. But Sydney's still a very strong performer. And you can see the rise really started to improve from September last year, Graeme. And we were saying that the whole time. Once those clearance rates started to improve, the market was rebalancing. And no surprise, once we moved over 70%, we started to see prices increasing. And that's what we've always said. It's something you should always watch on the weekend is the auction clearance rates and the trends, because they'll tell you how your housing markets are going. Melbourne, again, a very good result for Melbourne, 77.7% clearance rate over May, Graeme. Again, that's the highest, similar to Sydney, since October 21, when the market was blazing along post-COVID lockdowns. But again, you can see how that market did start to pick up. Its clearance rate started to rise from September last year, marginally, and it was the first sign that markets were improving. And we followed that, and of course, we've seen that continue to now having prices growth and near boom time clearance rates. We'll see if Melbourne can get to 80% over June. A bit more of a tougher ask. Brisbane, you can see how Brisbane's picked up, as I said, Graeme. You can see the trend there from Brisbane has been on the rise over the last 2 months. So we're not just making a spin out of the last weekend's results. Certainly that market has started to improve again. So watch out for Brisbane, folks. I think Brisbane's on its way back on those results. Certainly Adelaide just continues to record very strong results in terms of its auction market, hovering around about that 80% plus mark. And Canberra, again, we can see, Graeme, that Canberra has picked up this year after, as I said, having a late decline last year, is now recording much stronger clearance rates, still below where it was a year ago, but nonetheless certainly on the rise. So not sure there's any bad news there if you're a homeowner, Graeme. I think there's plenty of potential for higher house prices going forward. I think that we'll have another very solid June in terms of prices growth. Of course, those auction clearance rates are available every Sunday morning, the full results Sunday morning, but look out for Saturday night results on my LinkedIn channel, Doc Andrew Wilson. That'll come out between 6:15 and 6:30 every Saturday night, and the full results out on Sundays. So, Graeme, it's been, I guess, another positive week for housing markets. We've seen the monthly data for auction clearance rates very, very strong. Melbourne and Sydney performing at their strongest levels since the big bounce back we had post-COVID, just below 80% in Sydney and just below 80% in Melbourne. Brisbane looks like it's starting to bounce back as well. Similarly, Canberra and Adelaide as strong as ever. And prices, Sydney now 4 months in a row with quarterly house prices rising. Melbourne 3 months in a row. Same for units as houses, just as strong the unit market for houses. Prices, although they're up by around about 5% in Sydney and 3% in Melbourne, are still below where they were so far this year, are still below where they were last year. So I think that gives plenty of upside potential for value buyers to take advantage of the fact that this still is a market that's offering value in Melbourne and Sydney particularly. But I do think that'll drive prices back to peak results in both Melbourne and Sydney before the end of the year. So that'll mean about 10% rise overall in Sydney. And maybe we might even get 10% in Melbourne, which I still think is a little bit of a sleeper, not really sleeping because the results are strong. But I think that Melbourne's got some good pickup to still. Again, it sort of reflects that steep or sharp lockdowns that the Melbourne market had, and also the migration factor, which is all part of the same process because people left Melbourne in droves to get out of those lockdowns. And I think there's still a recovery there. I mean, Melbourne still has the most affordable rents for houses in the country, Graeme, capital cities. Yeah. And I think that's the migration factor. But I think sooner rather than later, they're going to, be heading back towards the same levels as, as particularly Brisbane and Sydney. Maybe not Sydney because they're a little crazy at the moment. But next week, of course, let's look forward to some interesting discussions. Firstly, we'll have our interest rate decision, Graeme, to chat about next week. Mm-hmm. Will the Reserve Bank put rates on hold? I think there's, maybe not so much of an outside bet as it was a month ago, but I think that there'll certainly be some interesting discussions when the board meets next Tuesday. And of course, if we do see rates on hold, it's good news for housing.
We see rates on hold. That start of the boom might be coming out if we see that confidence of another rate pause.
Yeah, that might stop them. That might stop them. They might think, no, we can't fuel this already hot housing market. So that might stop them. I mean, that stopped them from cutting rates back in 2018, in my opinion, because they were too scared. They just had too much focus on housing markets. It's been, my opinion, a big mistake by this Reserve Bank is they've got sucked into a lot of the negative housing market mantra, and it's cost them their credibility to some degree. But as I said, if it's not a pause next week, if we continue to see the easing in economic activity, and it's only a very slight easing, let's get this right. But if we continue to see it, it's going to mean that an easing in interest rates will come much sooner, or certainly sooner than many have expected.
No. I'm excited to see what happens with the RBA next week, so stay tuned, everyone.
And we'll have the rental data as well, Graeme. As I mentioned, we'll have the May rent report. I'm afraid there's not going to be any good news there for tenants, but good news for landlords who are, if they have to recover their costs, there's plenty of demand and higher rents for new rental properties, new listings out there in the marketplace. And, it's a nightmare for tenants, but it's, I guess, an offset for higher rates and maybe higher taxes is the fact that rents are probably rising now at the fastest rate ever, Graeme. Really, most consistently as well, across the board, almost every capital.
Hopefully, if we don't have another rate rise, there might be a little bit of a breath for tenants. So fingers crossed, let's see what the RBA do next week.
Okay, Graeme, all good.
Thanks, we'll catch up next week.
Thanks, Graeme.
Thanks, mate.